Hey guys, it's Adam Adams, and I want to introduce you to Ferenc Toth. We've got an opportunity. Welcome back, and I am happy to have you. I want to introduce you to Ferenc Toth and the infinite baking strategy. There is this crazy, awesome strategy that is all about, it's called Super Roth, okay? It's an alternative to like a Roth IRA. It's a way to put your money in one place and to capitalize on it a lot bigger than you can by just using some type of IRA. So without further ado, here's Ferenc Toth and the infinite banking strategy, aka Super Roth. Welcome back. Thank you for being here. I want to introduce you to Amber Bray. Amber Bray is going to go through the ins and outs of how to be able to. Hey guys, welcome back. And no, that's not what I want. Welcome back. It's Adam Adams, and I want to introduce you. Welcome back. It's Adam Adams, and I want to introduce you to Amber Bray, who is an assisted living expert. She's been doing it for the last couple of years. She owns a lot of well, I guess they don't call it doors, beds. Hey guys, welcome back. I want to introduce you to Amber Bray. Amber is an assisted living expert. She's got a couple residences right now that she's been running for the last couple years. You're going to learn a lot from today's lesson. And without further ado, let's just move right into the episode. Hey, welcome back. It's Adam Adams. And I want to do, oh my God. Hey guys, welcome back. I want to introduce you to Amber Bray, who's an assisted living expert. For the last couple of years, she's been running a couple of residences. You're going to learn a lot from her, so stay tuned for this presentation. It's Adam Adams, and I'm excited to introduce you to Lon Welsh. Lon Welsh is one of the presidents. It's Adam Adams. I want to introduce you to Lon Welsh. Lon Welsh is one of the founders of Your Castle Real Estate and First Alliance Title. Today, he's going to talk to you about some of the creative ways he's financed multifamily properties, including master lease options. You're going to want to stay tuned, so here it is. All right, we've got Greg Parham, the attorney for First Alliance Title. This guy is a genius, and he's talking about creative real estate from an attorney's perspective. You're going to learn a ton by sticking with this lesson, this episode. So without further ado, here's Greg Parham.
How are y'all doing tonight? Good. So this has been a fun thing. Adam called me, I think, Thursday and said help. So I appreciate you thinking about me and inviting me back up. I got to meet the Adam and Ollie, Manny and DJ last fall, and spoke for the Blue Spruce Group, I think in October. How many here have heard me before speak somewhere? Okay, good. A few. How many, I should ask, how many have never heard anything from me? Okay, so we got some newbies. All right. So we're going to have some fun. I'm going to cover a few things that you heard before. I'm going to try to do about half and half. I'm going to bring up about half the new stuff. I want to focus on a lot of things because this is a self-directed investment group. I want to talk a lot about taxes, tax deferred versus tax free, and those kinds of things that would be appropriate to you. Now, some of you may be asking, a financial guy, why is a financial guy here? I'm here for real estate. You're going to figure out real quick the two tie together if you do it wisely, very well. My background a little bit, I'll just tell you real quick. I've been in the financial industry 22 years, but in 2001, I was doing very well, top 10 in the country. Not saying that to brag, but I was doing really well. In the retirements, the IRAs, 401ks, doing the workshops, all that kind of good stuff. And my wife and I had a meeting with our CPA, and what did he say? You're getting creamed on taxes. You're going to get creamed on taxes because you're making too much money. So I said, you need some deductions. So I said, well, what do you recommend? Well, real estate has a lot of good deductions. So that night, fortuitously, a Carlton Sheets advertisement comes on the TV, and we buy the book, right? And then I'm a glutton for punishment. We go out and proceed to buy 22 properties over the next few years. HUD properties that we fixed. We actually fixed them up and did 3-year lease options. Why? Because that's what the book said to do. Okay? And this is why, and see, I didn't know people like Adam and Manny and DJ back then. I didn't know real estate investor groups and mentors existed. I wish I had, because that's all we had to go on. Now, that was in '01, and I'm from Phoenix. So from '01 to '04, the prices started going up, right? We get these properties back because guess what? When people have bad credit, what happens 3 years later? They still have bad credit. So they can't qualify, so we start getting these properties back. Now the properties are going up 30, 40,000 in value. We can sell them net of all fees or lease option them out for $300, $400 a month. Well, I'm greedy. I take the 30, 40 grand a month, profit, right? Because I didn't know any better. And our real estate agent at the time, who had helped us get all these properties, said, hey, I know this deal where we can buy land, develop 5 properties, which we did. We brought in the roads, the wells, built all of it, and made 85% profit in a year. And I said the dumbest thing I come to learn, yeah, this is easy. Let's do it again. Right? That was the beginning of the fall, we should say. We bought another 5 acres in North Scottsdale area, some high-end stuff, built 2 or 3 of those, sold those, bought 3 more lots. We were rocking and rolling, and then '07 comes rolling around. I'm thinking, oh my gosh, things are getting crazy. We got to start selling stuff off. So we did. The problem was we didn't sell it off quick enough. $4.5 million of real estate went to $1.5 million in a year. I didn't know how risky developing property was because I didn't have any mentor or anybody to tell me how risky it was. I was told by 2 BK attorneys to file bankruptcy. I'm stubborn. I negotiated, and I did a short sale in 2008 when nobody knew what that was. I had to educate the bank on what a short sale was. We did foreclosures, we did settlements, we did all kinds of stuff. That took about 2 years to unwind everything. And I think, got through that. Our credit's trashed, but at least we're out of all that. And then I get a nice letter from the IRS. I have $256,000 in taxes because the IRS said I made $1 million. I said, no, I didn't make $1 million. Well, you settled $1 million in debt. So now I got to spend the next 3 years negotiating with the IRS. They're even more fun than the banks, by the way, folks. So there's some practical experience here. Now here's the cool part. I wasn't able to say this last fall, but in December, we just paid off our last bill to the IRS. I am 100%, I stand here 100% debt-free. I don't owe a dime to anyone. And I haven't been debt-free since college, so that's a pretty cool thing. Okay? What I want you to understand is that if that's a goal of yours, that can be done. Okay? You can be millions of dollars underwater and end up, if you do the right things. You have to learn some things along the way. And that's what I did. And I started learning about some things like mentors, learning about money and how money really operates. So I'm going to share with some things that you're going to hear that you probably haven't heard from any other financial advisor. First of all, let me share a bit. I'll give you the 1-minute commercial. This is who we are. Our mission is to improve the financial future of individuals and families. What we do is we create sustainable wealth, secure financial futures, and establish family legacies. How we do it? We use the client primacy principle. We put our clients in the first, second, last priority is put them in a better position. I tell our agents that all the time. Take care of the clients, take care of you. It's not that complicated. How we do it, we use a comprehensive, holistic approach. We look at all the entire picture, okay? Legal, health, tax, all of it, and put together a plan that makes sense with our strategic partners, attorneys, CPAs, you name it. Somebody asked me, I think, DJ, do you know, I'm looking for a guy that's really good in the cryptocurrencies. I know a guy. So we've learned to develop this. We're one of the leading guys in the country, by the way. Our asset protection attorney has worked with the last 3 U.S. presidents, just to give you an idea. We don't mess around, okay? Well, how we do it, we create tax-free income, eliminate market risk, and manage what we call your personal bank. That's what I'm going to talk about today. Those are also sometimes called super wealths, by the way. So we're going to talk about that. 15th year A+ rated BBB. This is a little bit new, but I thought, I was looking at some marketing stuff, and it makes sense. What people want to know is, who are you? So this is who I am. I'm not saying this to brag. This is who I am. I've been speaking on financial literacy now around the country for the last 3 or 4 years, and I found it's a passion of mine. I actually even teach a college course on that, okay? 25 years of being a successful business owner, 18 years as president, and I'm now, the newest thing is, I just got approached recently, I'm now one of the founding members of Rio Salado Bank. One of the things that's pretty interesting because I teach people how to think like bankers versus investors. And guess what? I'm on the board of a bank now. I think I can teach you how that works, okay? Right? Got a little credibility there now. So, and by the way, the guy that approached me was because of what I was doing. He says, we need a guy like you on our board. So that's pretty cool. I was the former, by the way, that's the former treasurer of the state of Arizona and the former chairman of the Arizona Corporation Commission who approached me about that. So it's kind of a fun thing. But anyway, what I do is I teach people how to think like a banker versus investor. Like I said, establish personal banks. The bottom line, like DJ was saying, take control of your money. It's your money. It's not the financial advisor's money, is it? It's yours, right? Earn more, create tax-free income. That's the bottom line. And this is what's important to me. My girls. This is my hardest part, but my older daughter was diagnosed with autism at age 4. And this is why I do what I do. And when guys like Adam call me and say, can you fly to Denver to come speak? Is it convenient? No. Do I love what I do? Yes. But I'm doing it for them. Okay? Because my daughter is going to need, she's going to need something there for her even after I'm gone. Does that make sense? Okay? So, you'll understand me better that way. And my wife made me do this, but what I enjoy, I'm actually a semi-professional bass trombone player. I got a gig tomorrow night, so I fly back tomorrow and I got to play a gig. So, anyway, fun. But life's not boring, right? And I was in the military, great experience, all that kind of stuff. So that's me. That's who I am. So enough about me. I want to share something here. And this is going to be very powerfully important for all of you folks in this room. The household income in the United States, according to the IRS tax return, so that's the most accurate measurement you can get, is if you make $150K a year, you're in the top 20% income earners. If you make $24,000 a year, you're in the bottom 20. So anything in between, you're in the middle 60 or the middle class. Okay? So here's what is interesting. If you look at the budget of top, middle, or bottom income earners, it doesn't matter. The percentage of income is the same. Housing, food, transportation, all those kinds of things. The percentage of money we spend is basically very similar, with 2 exceptions. And those 2 exceptions happen to be education and insurance and retirement. Those are the 2 exceptions. The one thing I find very interesting is even the poor, the bottom 20%, spend more on education than the middle class. And see, that's where some of my passion is. You all are here for a reason. You're here to learn something, to better yourself, to improve your knowledge. I'm speaking to the choir. Kudos to yourself. I just want to say that. We could all be somewhere else tonight. So kudos to that. By the way, one other thought on this. You know how I saw this on a study recently. You know, the average corporate CEO in America reads 50 books a year. And the average American reads 1.5, and the majority of those are romance novels, by the way. Now, can we agree corporate CEOs are busy people? So, tell me you don't have time is not an excuse. It's about priorities, right? So, some of you have heard this. Who you are as a person is a combination of the books you read and the people you hang out with. So I'm going to encourage you to read some books, and you're hanging out with some great people, by the way. And I want to tell you this, too. There's nothing here for sale tonight, so you can relax. I'm not here to sell anything. The only thing I'm going to recommend is reading some books. And I'm going to recommend a book or 2. We have a couple of them here, because I can carry a few on the plane. Or you get them on Amazon. I don't really care. They're $25 either way, okay? That's it. That's the only thing I'm going to tell you tonight. So relax. We're here to learn. It's purely educational. And the why I do that, the better I educate you on something that makes sense for you and your family and your business, the more likely you're going to do it, right? Fair enough? So, here's what I'm going to say to you. If you're expecting the same advice you get nearly everywhere else, buy stocks, bonds, mutual funds, and diversify, you're in the wrong place. You might as well eat your dessert and head on out because you're not going to learn anything tonight about that. But if you are looking to do what the wealthy do, create sustainable wealth, you are in the right place because that's what we're going to talk about. And that, I always talk about sustainable wealth because that's the #1 financial goal for most people, right? Yeah. That's bottom line. And I always ask, what does sustainable wealth mean to you? Anybody? Last to your 100. Well, you may want to revise that. Have you seen some of the statistics on longevity? Yeah, last not only your lifetime, but maybe beyond you, right? Ongoing income, right? That kind of thing. Now, here's a question I always ask. Do most people you know personally have the sustainable wealth that they need to live on? Why are you listening to them then? Right? In fact, one of my mentors, I've mentioned this asset protection attorney, he shared something at our workshop we did in Phoenix last year that was powerful. He said, we all know the 80-20 rule. Whatever the career field, 20% do 80% of the work, 20% know what they're doing, 80% are average, mediocre. Hey, if you're getting heart surgery, do you want the 80% doctor or the 20% doctor, right? Okay? All right? That holds true for a financial advisor, a CPA, a real estate investor, or a bricklayer, right? Doesn't matter. But he said there's one other category. He says it's the top 2%. He calls those the rock stars. In other words, do you think somebody who is not a top 2%er can help you get there? So be careful of the advice you're getting for people. Your so-called advisors, the professional advisors, there's a 98% chance they're a 98%er. Right? Now, I'd like to think I'm not an 80%er. I'll let you guys decide if I'm a rock star or not. Fair enough? All right. So, financial advisors, we're taught that we all need income when we retire. That is true. But here's what I've learned. When you're starting out your career, what do you need financially? When the car breaks down, you need roof leaks. What do you need? You lose your income, job or business income. What do you need? You get sick or hurt, can't work. What do you need? And when you retire, you need cash flow, right? Guess what? You need it all through your entire lifetime, right? We all do. Guess what? What's the number one obstacle to creating sustainable wealth? Not enough cash flow. In fact, anytime you've had financial stress, it always comes back to the same thing. You didn't have enough money. You didn't have enough cash flow, right? And what if so you're in the right room. You're learning how to develop cash flow. One of the reasons I agreed to when Adam called is I love what these guys are doing. By the way, I speak last month. I was in LA 3 times speaking to 3 different real estate investment groups. Okay, I speak to groups in Seattle, Vegas, Phoenix, of course. These guys are. I told a lot of people you want to come and meet these guys because I'm telling you they got it going. They know what they're doing. We got things happening, and I can't say that about everybody I meet. All right, they're rock stars. I'm going to tell you, Blue Spruce is a rock star group. They didn't tell me to say that, but they are. Okay, that's why I agreed. I want to encourage and support that. I'm excited about what they're doing. Okay, so think about this a minute. If you're that situation where you lost your income, business job income, what if you'd had your basic expenses covered? How would have that experience been different? Emotionally, stress-wise? Big time. No comparison, right? So, if our primary financial needs are cash flow, why do most investors focus on appreciation? I mean, every time we talk to somebody, hey, I made this percent last year, or I made this percent on this deal. Is that right? Why do we focus on that? Well, the answer mostly comes from Wall Street. Can we agree Wall Street's good at marketing? They're phenomenal at it. Okay? See, here's the thing. If you invest with a typical financial advisor, how do they make money? I'm sorry, let me back up. How do you make money? You buy a stock or a mutual fund or whatever, it has to go up in value, right? Appreciation. How do they make money? I already heard it. Fees. Money under management, right? Do they make their fees whether your account goes up, down, or sideways? Yes. Is that called cash flow? Yes. For them. See, think about it. You could buy a stock or mutual fund. It could double in value. Wall Street's happy to let you have all the gains, right? They just want the cash flow, baby. Which is smarter? Again, like Wall Street, hate them. I don't care. We can agree they're also savvy about money, aren't they? Okay? So, there's 3 ways to create more cash flow. You can make more. You can spend less. Reduce your burn rate. Everybody know what that means? It costs a certain amount of money to live, right? So one of the things we do a lot of times, we show people how to reduce their burn rate. Okay? And you can do some of both, capture interest, and I'll talk about that briefly. By the way, I'm going to show you the secret of how to get wealthy. Everybody ready? It's very simple. It's not, all you have to do is increase your income, decrease your expenses, and create a gap, right? You do that consistently, and the bigger that gap is over the longer period of time, you'll create wealth, right? That's it. It's that simple. Now, I didn't say it was easy, did I? But it is that simple. All right? So, you want to create consistent. Now, there's three enemies that we face all the time, and we're going to talk about this a little further here, because the enemies are consumer debt, taxes, and market risk. Those are the big three. Okay? Bottom line is, when it comes to debt, you need to understand the difference between strategic and consumer debt. Big difference. Strategic debt is what's called good debt. It's where you take it, someone else is paying, covering that debt. And a great example is a rental property, where the renter is covering your mortgage, right? Can you build wealth that way? Absolutely. Bad debt is debt that's based on your efforts. See, one of the things I was talking to Manny and Adam and stuff today was, one of the things when we work with the clients is many times their financial situation is upside down. They want to invest in real estate, and education is great. Don't get me wrong. Nobody can ever take away education. And if your financial situation here is totally messed up, you should still be here to learn. But you may not be in the position to be able to do anything yet. Because you got to fix this first, don't you? We all understand that if you make a credit, if you make minimum payments on a credit card, you can pay up to 20 years to pay it off, and you'll pay up to 4 times the cost of the item. So I say, if you buy something on a credit card and you don't pay it off quickly, it better be worth it, right? Because I don't care if it's on sale, you're paying premium, aren't you? 2, 3, 4 times the cost, right? So, why is this a big deal? Most people say, oh, why are you talking about debt? Here's why. The average American earns $1.8 million in their lifetime with a college degree or higher. The average American pays $280,000 of interest in their lifetime. Not principal, interest. That's 15% of your lifetime income. Are the lenders doing okay? Don't feel sorry for the banks. They're doing just fine. Okay? So my point is, debt sneaks up on us. Most of us don't realize it because it's a few $100 a year, a few $100 there, right? Folks, it's $250,000. And if it's a couple, you're talking about $500,000, aren't you? I don't know. That's a lot of money to most everybody, right? Okay? So the key, the secret, is to recapture that interest. See, we all have an income stream of some sort, or we wouldn't be here, right? Can't live without income for very long. Okay? My point is, there's money coming in your pocket, and there's money going out. Every day, right? Are you capturing any of that interest? So I'm going to teach you what banks do. See, we all have a checking account, right? Whether you're an individual, business, whatever. Your checking account money has flown in, right? And it has money flowing out. Now, do you earn interest on that money today? Anybody earning interest on their checking account money? You are? What interest rate? 2.25. All right, we'll have to talk because I got to find out where you're getting that. I'll show you how to make double that. But anyway, but the fact you're getting any interest is great. Okay? Here's the thing for the rest of us, except this smart gentleman here. The rest of us aren't making anything, are we? Is the bank.
Yes.
Big time. What if you could capture some of that interest? Now, by the way, here's the big deal. Remember, this is money that's coming in and going out every day, right? Am I talking about extra dollars? No, I'm talking about your actual transactional monies. Do you realize if you did this as a business, we use this as an example, let's say you had $30,000 a month coming in a business. That's not a real large, small business, is it? For some businesses, that can be a small portion of what comes in. But if you captured interest on $30,000 a month income off of a business, do you realize that'll create $1 million tax-free to you in 18 years? Now do you understand why banks want business accounts? They're making $1 million. By the way, the average lender in the United States is making, the average American in the U.S. is earning over $1 million for lenders in your lifetime. Now, the lenders can make the money, or you can. Which do you prefer? All right? So what if, again, you capture some of that, you made it, let's say you just doubled it. I'm being very conservative. Hopefully you can double your money in your lifetime. million into $1 million then, right? By the way, it's a crime not to retire a millionaire in America. Pay half the interest, double the returns on it, and you're a millionaire if you're a couple. It's that simple. Again, not easy, but it's that simple. Now, if you want to learn how to capture that interest and double it, I'll show you how to make double that return. We can talk. Now, I want to talk about tax-free income because this is where I think a real key in terms of self-directed. And we're going to talk about some self-directed stuff because it involves taxes, right? Why are you doing a self-directed IRA? Why are you doing an IRA at all? There's one big reason, right? Taxes. So let's talk about taxes. Nice, fun subject. But important. This is an account that's taxable, tax-deferred, or tax-free. Everything being equal. Tax-deferred, IRAs, 401ks is better, but tax-free is quite a bit better than that, isn't it? And most financial advisors talk about, well, get your money into an IRA, 401k, that kind of thing. So you move into the tax-deferred category. But there's a better category. See, in fact, this is what a taxable versus a tax-free investment looks like over time. Compound interest is something that works for your favor or against you, doesn't it? It's significant. My point is this. When it comes to taxes, there's two powerful questions you always have to ask yourself. This is what's important. First one is, if everything's equal, which is typically better? Should you pay tax on the seed or the harvest? What do you think? Seed. Right. But what are you doing with a self-directed IRA? The opposite. Aren't you? Because what you're doing is you're deferring the taxes now on a small amount of money to then later have to pay it out on hopefully a larger amount of money or the harvest, right? Retirement. Am I right? Okay. Now, why are we taught? You all have the right answer, but are doing the exact opposite in most cases, right? Why? Well, the reason, why do you defer tax? We're always told, why do we defer taxes? There's always one big reason. You're going to be a lower bracket in retirement, right? Can I share a little secret with y'all? If your goal is to be a lower bracket in retirement, you're in the wrong room. Right? You better stop doing what Adam and them are teaching you because you're going to mess all this up. Right? But here's another thing about that people don't realize. Okay, so my point is, if you're in a lower tax bracket in retirement, it means you're making less money. Does that sound like a good goal to anybody? No. And be careful what you wish for, because those things tend to happen, don't they? In other words, what you focus on, I'm not here to preach to anybody, but we all know, I think most of us know this, what we focus on tends to happen, right? And if your focus is I'm deferring taxes so that I'll be in a lower tax bracket in retirement, and you repeat that enough times, what happens? You end up accomplishing that goal because you put it out there, right? In my opinion, bad goal. Bad goal, go away, right? And there's another thing about that goal you don't want to accomplish. Why you don't want to accomplish it? Anybody heard of something called inflation? You realize that 3% inflation rate, that the prices of things double every 20 years. So, even if you're the same income rate, everything's going to cost twice as much, or in other words, half the buying power with the same income. So not only should you not only consider, will my income be the same in retirement, but how can I make it increase? And that's what Blue Spruce, what they're doing, that's a big part of what they do, which is awesome. You should start considering having your income increase in retirement, unless you want less buying power. Because are you going to live for 20 years in retirement or more? Most of us? Yes. Okay? So that's why I don't recommend it. By the way, we're taught to defer taxes because we're told we're going to be a lower tax bracket. And also the real reason is, who created the IRA and the 401k and the Roth, by the way? Yeah, the federal government. Now, when they create things, they typically in their best interest or ours. By the way, don't sell them short. They're also smart too. I don't care who's up there. They're smart. Okay? By encouraging tax-deferred growth, they created larger tax revenues exponentially in the future for themselves. That's exactly what's happening, right? So I use a simple example. Let's say you defer $1,000 into an IRA, 401k, whatever, and let's say you're in the 25% tax bracket. You would defer $250 in tax, right? let's say that money doubled a couple times in the long run, which is you want to have happen, right? We want that money to grow. And then you took it out, assuming you're in the same bracket in retirement as you were working, you would pay in tax what you put in. Who won, you or the IRS? Okay? See, I'm here talking to self-directed IRAs, and I even said to Adam, you can vouch this last week, you sure you want me to come and speak? Because they may not like what I'm going to say. But it's the truth, isn't it? And I speak to a lot of RIA groups and there's a group, I can tell you, in Seattle, I went and spoke up there, and then I go to these conferences, and self-directed IRA folks, every time they see me, I get the stink-eyed, and they go elsewhere. Okay? I'm just telling you like it is. See, one of my other mentors, and by the way, my experience with all that real estate, and I told you the history, you know what the biggest, most valuable lesson I learned, my wife and I learned from all that? We value mentors today. One of my mentors is a 30-year-plus tax attorney. Demas. You've met Demas. And he teaches this. I've been in a meeting with him teaching this to Fortune 500 boards, where he will literally say, look, you want to move your money above the line. Okay? That yellow line is the key. In other words, all money, think about your money, and there's 4 categories it fits in. It's either free, tax-free, tax-deferred, or taxable. Okay? Now, free money is things like 401k company matches. Now, you heard me just say I'm not a big fan of IRAs and deferring, right? Well, guess what? Whenever there's a rule, there's always an exception, right? What's the exception? If you have a 401k through your work and they give you a match, do it. Why? It's free money. Never turn down free money. I have a 401k with a company match. Okay? It's free money. Why would I turn it down? That's stupid. Okay? But don't put more in than the match. That's dumb, right? That's foolish. Okay? Inheritance and legal judgments. Those are also are free money. Unfortunately, most of those 3, we don't have a lot of control over most of those options, right? Tax-free money is tax-free municipal bonds, Roth IRAs, insurance proceeds, and loan proceeds. Okay? Loan proceeds, many of you are familiar with, using things like cash-out refis and line of credits. Have you notice when you get one of those, you don't get a 1099, do you? It's not taxable, is it? It's loan proceeds. Can you then take that money and reinvest and make more? Now, you may be taxed on the gains on your investment, but what the seed money, the monies you used, you're working with tax-free money, aren't you? Smart. Okay? Tax deferred. That's your IRA 401k, but here's the thing. That's the only type of investment that actually changes category, because you've heard of something called RMDs, or required minimum distributions. At a certain point, you build an IRA or 401k, self-directed or otherwise, at some point you're going to have to start pulling money out of it. By the way, when you turn 70 and a half. Okay? And guess what? Now it becomes taxable. All right? And then everything else basically is taxable. So his point is, look at your money, move as much of it above the line as possible. Okay? And that's what we work with and help people to do. Now, let's talk about some specifics about self-directed IRAs. I want to get into this a bit, because that's kind of what we're here for, at least tonight, right? A self-directed IRA works just like any other IRA. In other words, all the rules that IRAs have, it has the same rules. Okay? The only difference is, typically, you have a wider range of investments, including real estate. And that's why most of you here use them, okay? Now, we also know there's more fees and rules with a self-directed than there is with a regular IRA, isn't there? Okay? This is where you get yourself a little bit of trouble. The other thing is about self-directeds is they typically involve higher risk, because in many cases you're dealing with higher risk investments than traditional investments. But also, what I find is in many cases, particularly in the real estate world, most people who have a self-directed IRA have enough money in their IRA to do maybe 1, maybe 2 projects, right? Let's say you have enough money to buy 1 house in your self-directed IRA, and you buy that house and do that deal, whether it's a fix and flip or a long-term buy and hold or whatever it is. But let's say something goes wrong. Does stuff ever go wrong in real estate? Of course it does. Well, here's the risk. Here's the problem. If the deal goes south, so does your retirement account. Think about that a minute. Should you be risking your retirement monies like that? In other words, let me use an analogy. If somebody ever recommended you to go take all your money and buy one stock, would you do it? No, it's crazy. Why do it all in one house or one property? Is there any difference? Most people don't think about that. And I've seen too many cases, disastrous situations, and it's sad. Okay? So just be careful about that. That's what I'm saying. I'm not saying never do it. I'm saying be careful about it. Okay? So, prohibited transactions. Anybody familiar with those? You? Okay. You've got a number of things that you cannot do. And this is, again, where self-directed investors get in trouble. The key thought you want to keep in mind is there has to be no self-benefit. That's the term the IRS uses. And what that means is, I'm going to use some typical examples, particularly in the real estate world. The most common ones are you purchase a property from an immediate family. It's considered self-dealing or self-benefit. You can't do that. No sweat equity. You know, if you buy a fix and flip and you lift a hammer, you're violating the rules. Okay? And you can't live or vacation in that property either. Those are the big three. And guess what? If you get caught with any of a prohibited transaction, what happens? You got the IRS on your, and you got taxes and penalties, and they're fun to deal with, right? Right, exactly. So those are things you want to be very, very aware of. You want to have a good IRA custodian, okay? Adam has a guy, he said locally, does self-directed 401ks he like. In the IRA world, I prefer Provident Trust, by the way. That's the one that I get universally. They were rated number one last year by Wealth, and they're the fastest growing self-directed IRA company in the United States. They're a big boy, but I like them because of their service and just dealing with a lot of real estate investors. I get a lot of feedback, and I use them personally myself. So I have no skin off my nose if you use them or not. I'm just giving you a free recommendation. All right? You're looking for one. Then they're out of Vegas, by the way. Provident Trust. Now, when it comes to IRAs, regular IRAs, self-directeds, or otherwise, the question you got to ask yourself is this: should the government control your money? Because we all know there's age restrictions, contribution limits, penalties, taxes, all that kind of stuff. And the rules are changed frequently. And what if those rules don't fit your plans? Right? So those are things you always want to consider. Second big question on taxes, the last one I want to ask you is future tax rates. Here's another reason why you want to really seriously consider, does this make sense? This is the federal debt. They owe $20 trillion right now. That's what they admit to. And here's the question I'm going to ask you. Can anybody predict what future tax rates are going to be? Can you predict the political winds 10 years from now? Who the heck knows, right? Now, it's a fact historically, with the new tax laws that just passed, we are at historically low tax rates, the lowest tax rates we've seen in 40 years. That's a fact, federally. So, if you're going to look at getting out of a taxable situation, everybody familiar with a Roth conversion? Turn the chart. Okay. A Roth conversion is basically taking a traditional IRA, which could be a regular one, a self-directed, whatever, doesn't matter, and you move it to a Roth. The difference with a Roth is you pay the tax up front, and then it grows tax-free for life, right? The catch is you got to pay the taxes going in. All right? So you got to really look at the numbers and see what makes sense. But if you're looking at doing a Roth, if you look to do a Roth conversion, when should you do it? When tax rates are low, right? Particularly for your situation. If you have a situation where you have a carry-forward loss, or you've lost a job or business income, and you have a blip, if you will, in income for a year, great opportunity to start looking at conversions. That's when you want to do it. Plus the overall tax, by the way, if you're looking at, you can also convert over multiple years, and the tax laws on the books right now will stay on the books for 10 years unless Congress changes them again. So we got an opportunity is what I'm trying to say, okay? So somebody will say, well, our tax rates, again, there they are. I couldn't find a newer chart. They actually dropped. So we're in this range right now, which historically, that's since income tax was invented, we're historically at low rates. So that's when you think about this a minute. if you continue to contribute to an IRA 401k of any stripe, you're contributing on the seed a small amount of money, right? At a historically low tax rate. To then have to take it out at some point in the future, hopefully a bigger amount, at an unknown future tax rate. Is that right? Does that even make sense? I'll let you answer that. Now, there have been several efforts to tax IRAs and 401ks, by the way, by the federal government. 3 efforts have been made so far. They haven't passed yet, but they've been voted on. And why do they want to tax them? It's real simple. According to the IRS, there's about $20 trillion in total IRA, 401k, and Roth assets in the U.S., and they owe about $20 trillion, right? If they can tax, they created it, right? Can they change the rules? Absolutely. If they tax this, they can service the debt. By the way, we don't have a debt problem. The U.S. does not have a debt problem. We have a spending problem, yes. But we really don't have a debt problem. So when people talk about debt and stuff, don't worry about it. I mean, I've been to enough conferences and enough economists and all that. Here's the bottom line. If they change the rules, which they're trying to do, and they tax this, the debt is serviced. You're the renter. They're the landlord. Get it? By the way, has anybody ever seen I'll throw one more thing at you about IRAs. Anybody ever seen an IRA statement? What does it say on the top? Usually it's your name, and then it says custodian of something like that. Do you know what that means legally? Does anybody know? You don't own it, folks. You're the beneficiary. Now, everybody understands life insurance well enough to know that who controls the money of a life insurance policy? The owner or the beneficiary? Hello? Folks, you don't own it. I can prove it. Anybody ever heard of GM? Some of our clients, their retirees got their benefits cut by 3/4. Went through bankruptcy court, slashed it. Anybody heard of some of the airlines? Like we had in Phoenix, US, what was it? US Airways, thank you. Some of my clients worked for them, went through bankruptcy, cut their IRAs, 401ks in half. You don't own it, folks. Just letting you know. Now, will your financial advisor tell you that? Or the company you work for? No. But look it up. And by the way, some people say governments will never tax IRA, 401k, Roth. Really? All these countries have since 2008, and the most recent was Britain. So the precedent is there. Okay? So, anyway, how does it affect your retirement accounts? Your self-directed IRA? Well, if you're at 0% tax and your account's worth $100,000, it's worth $100,000, right? If you're in the 15% bracket, it's worth $85,000. If you're in the 35% bracket, it's worth $65,000. Do taxes make an impact on retirement accounts? Big time. Okay? And we don't know what the tax rate's going to be when we need the money, do we? And probably higher because we're at low rates. But anyway, so that's what you need to understand about taxes. Let me cover this last key and then I'll get to a solution. I've got to share this concept with everybody because so few people truly understand it. And I mean really successful, sophisticated investors don't understand this most of the time. And what it is tapping into the power of compound interest. And I'm going to illustrate. Most people think of compound interest in terms of a linear progression. You have to understand the difference of average rate of return versus compound interest. And this will be true for financial investments, real estate investments. I don't care what the investment is. This red line is an 8% average rate of return with a 20% loss in a 10-year period. Okay? The green line is a 5% compound interest line. Now, if I'd ask which is better, 5 or 8, we would all agree 8, right? But look who wins. I've had people argue with me and say that's not a true 8%. And I say, yes, it is. What it is 9 of the 10 years you made more than 8. 1 year you lost 20. By the way, does that ever happen? Real estate, stock market, pick a market, Bitcoin. One of my clients was a multimillionaire in Bitcoin 6 months ago. Okay? Anyway, the Point is, 9 of the 10 years you made more than 8, 1 year you lost 20, you average that out. So if this was a mutual fund statement, your statement would say 8% average rate of return over the past 10 years. Yet, a 5% CD would have more money in it. See, folks, this is math, but most people don't follow math that closely. And I bring this up because I have people tell me all the time, you talk about 5%, my investment's better, I make 7, 8. You're talking apples, I'm talking oranges. You're talking average rate of return, I'm talking compound interest. Okay? So be sure you understand what you're talking about here. Now, the other thing we've all heard, when you're young, you got time to make up for losses, right? All heard that one? What if the loss occurs in the first year? 9 good years, and you still haven't caught up to what that 5% CD would be doing. Interesting. By the way, if you really understand compound interest, I took this out 10 years. What if I took it out 15 or 20? Any idea what that green line would look like? Compound interest increases at an increasing rate. It gets harder, right? The last one, what if their loss occurs at the end? You're ahead for a while, but look who wins. This is 0809, my 401k turned into 201k. Remember that one? Yeah. It's sad. I dealt with a lot of those clients. So here's what I want you to understand about the power of compound interest. If you get one thing tonight from what I'm sharing, I want you to get this key right here. I'm teaching you a concept called the true value of a dollar or loss opportunity cost. And here's what it is. If you have $10,000 today and you're 50 years old and you invested that 10 grand at 5% interest, that 10 grand would be worth $55,000 in your lifetime. If you live an average lifetime. If you're a 30-year-old, it's going to be worth $140,000. Okay? Why is this so important? You spent 10 grand today on something. Did that item cost you 10 grand or something more than that? I'm teaching you a wealth key here, folks. This is something about how the wealthy think about money. This is a paradigm shift in thinking that 99% of Americans don't understand, but 1% do. You got a cup of coffee and you spend $1 for that. Trade that dollar for the cup of coffee, right? Did that cup of coffee cost you $1 or something more than the $1? More. In fact, if you're a 50-year-old, it costs you $5.50. Right? Because that dollar could have worked for you. If you're a 30-year-old, that cup of coffee costs you $14. In fact, I use an example all the time. I got a younger guy here. I say, millennials can't be taught anything, right? And I beg to differ. I've taught a ton of millennials, a lot of lessons about things. And you got to talk to them in their language and help them understand. And I usually usually it's true. And I love them. Here's my point. Most of the time I'm referred to them by their parents, right? So they'll meet with me, and most of them are nice folks, and they always want to meet in a coffee shop, right? Fine. And they usually buy, because they're nice folks. So I let them. Then I teach this. And literally, I'm not kidding, almost without a fail, they will look at me, they'll look at the 2 cups of coffees they just bought, and they will say, and I quote, "Crap, I just spent $100. Right? They got it. Right? The only bad thing about the story is that next time I meet with them, I'm buying because they learned the lesson. At least I can deduct it on my taxes. So, so it's not as bad. You get my point I'm trying to say. I'm not saying never buy a cup of coffee, never buy a car, never buy a house. What I'm saying is understand the true cost of the item before you purchase it. Also another way to apply this, if you're looking at an investment, will this investment give me a greater return than what this money could make for me already? I see 2 people far too quickly jump into investments too quickly, take too much risk, because they hop and they think they have to put their money to work. If you put your money to work and an investment's making 5%, I can show you a guaranteed tax-free insured at 5%. I'm the worst guy to talk to about investments because my money's making 5% guaranteed insured and tax-free. Your investment better be better than that. Right? Because I know my money's going to turn into 5 or 10 times if I do nothing. So your investment better do better than that to make sense. Otherwise, it's a bad investment, right? By the way, that's how the banks think. When we have our twice a monthly board meeting and we look at loans, that's how we're thinking. Is this better asset? Better to deploy the dollars here or there, or let them sit where they are. Does that make sense? So, the worst compound interest destroyer, this is the last thing I'll share with you on this, is people underestimate this, and it's losses. Those are the most difficult to overcome because you have to, in most cases, if you lost some principal, you lost money you worked hard to get together, right? Many times years of work to gather that initial seed money. Am I right? So you've got to replace that time to replace that dollars, right? And so you didn't lose the money. You did lose the money, but you lost time, the momentum, and the compound factor. Does everybody understand what money, compound interest, dollar turns to 2, 2 to 4, 4 to 8, 8 to 16? If you lose, you didn't lose $1, you lost the 8 to 16. In the last decade of your life. Hello? And that's why, if you ever anybody read the book Snowball? Pretty smart guy about money, okay? He talks about the number one, this is his most famous quote. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Most people don't really understand what he means, and in his book he explains what I just explained. It's not about losing the money that's so critical, it's losing the time. Money can be replaced. Time can't. Right? Okay? So, our point is simple. Power of compound interest. 5% compound interest outperforms 8% average rate of return. If there's loss of 20% or more, no matter when the loss occurs, what are the chances of a market loss in the next few years? I don't know, you tell me. That's where the S&P 500 is right now. By the way, if you're in the market, get out of the way. Please, do yourself a favor. Okay? Don't be greedy. A correction's coming. I don't know when. I don't know how long or how. Nobody can tell you how much, but it's coming. Okay? History tells us that. All right? That's all I'm going to say. All right. What time are we looking at? I need a... Okay. Can you give me 10 minutes? All right. Let me give you the solution. Personal bank. Simple as this. If you understand how to create a bank, you got to think like a banker. And here's how you think like a banker. First of all, you have to stop thinking like an investor. Here's how investors operate. They trade hard dollars for assets with the expectation the asset will increase in value. Right? Focus on potential gains only, mostly create little or no cash flow, and rarely ask what's the recourse if it goes wrong. Right? See, the problem is if you buy stock, piece of business, or real estate, can you tell me what it's going to be worth in a year? You can run spreadsheets, you can guesstimate, but you don't know. Right? So this is in the Rich Dad, Poor Dad book. Anybody read that one? Robert Kiyosaki, who I got a chance to meet, has said, he's in the book, investing primarily for appreciation is just another form of gambling. He's right. Might as well go to Vegas. Okay? So returns uncertain, little or no cash flow, no downside protection. Here's how a banker operates. How many people has ever gotten a car or auto loan? Almost everybody in the room, right? When you signed the papers, you knew you'd have payments, right? Did you plan to make the payments? Of course you did. You wouldn't sign the papers otherwise. Plus, you went through a qualifying process to do it, right? Guess what? If you don't make the payments, what happens? They take the asset. Is the banker really risking their money? No. You realize lenders hardly ever lose money on collateralized loans? In fact, before I just agreed to join the board, I did some research, and I found out in the last 10 years, over 3,600 community banks have been started in the United States. Do you know how many of those have failed? Out of over 3,600. 1. In other words, the banker creates secure cash flow and protects their downside, don't they? Because they'll take the asset and sell it to somebody else and create another cash flow. You can do the same thing. So criteria for good investment is always what's the cash flow and what's my downside protection, right? So, creating a bank. When we get a check, what's the first thing we all do with it? Deposit it. What's the bank do with our deposits? Loan it out. Cars, houses, credit cards, right? All right? If you walk into a bank, you open an account. The next person walks into the bank and wants to get a car loan. Does the banker take the cash you just gave him and give it to the car loan person? See, most people think the answer is yes. The reality is the answer is no. What they do is they take the cash you just gave them and stick it in the safe. Is cash an asset? Of course it is. Can you borrow against an asset? Of course you can. So, banks don't invest in the stock market. It's public record. B of A, Wells, Fargo, Chase, pick a name, I don't care. None of them invest in the stock market. They earn compound interest on their deposits. They borrow against the cash they hold and create more interest. So can you. And here's how we do it. We do it through a personal bank. It creates an asset that's guaranteed and insured. An asset like is a property. It's an asset you can borrow against, right? You have access to capital, by the way, day one. That's another thing I get asked all the time. You earn interest on the asset and the borrowed funds. That's huge. You also, it's tax-free, growth and withdrawals, which is pretty sweet. You'll get 2 to 16 times more total dollars to spend in your lifetime doing this versus not doing this. And that's all a matter of how long you live, right? The compound interest factor. We use insurance as the tool. Now, please don't confuse the concept of personal bank concept with the financial tool. They're two different things. We could use a mutual fund, a CD, an annuity, or anything else. We use insurance for a reason. We want compound interest. We want increasing cash flow, right? We want no risk of loss. You want to borrow against an asset. You don't want to lose value, do you? So that knocks anything market-related off the table, doesn't it? We want liquidity day one. CDs and some annuities have safety, but they don't have that kind of liquidity, so they're off the table, right? We want access to the funds, no penalties, age, or other restrictions, so the whole IRA, 401k world and self-directed world is off the table, isn't it? Right? We want to be in control, not someone else. And tax-free growth, tax-free withdrawals, tax-free to the heirs. See, can you chop a tree with an axe? Can you chop with a chainsaw? Which is more efficient? This is the chainsaw. Now, our biggest problem, Frank and I's biggest problem, both Franks, I should say, when we say, look, you need more insurance, many people say, oh my gosh, I've already got the car, the home, the last thing I need is another bill. They stop listening and miss the whole point. That is not what we're talking about. What we're talking about is an asset and the type of it. You understand there's lots of different kinds of insurance out there. There's lots of different kinds of mutual funds, right? But there are a lot of different kind of real estate. Are apartments different than single family? Which are different than duplexes? Which are different than, you see what I'm trying to say? Okay. We use a high cash value investment grade insurance or what the banks buy. By the way, the bank that I'm a board of, we're looking at buying some of this for the Tier 1 capital for the bank. That's what they do. Okay? Billions of it, by the way. So there's lots of different kinds of insurance. I'm not going to spend a lot of time on that today. That's for another time. Understand, we're going to recommend the best one. See, how many people in this room have a life insurance policy on them? Okay? No, you don't. What you have is death benefit protection, right? You're paying a premium in case you get hit by an ice cream truck. Your heirs get paid, right? Now, it's sold as life insurance, but if it's on you, will you ever see the money? So how's that life insurance? The industry calls it life insurance because that sounds better than death benefit protection, right? But that's what it is, right? And by the way, I have some of that also for my wife and my family and kid and the business. We have those needs. Okay, I'm not against it, so you understand what you've got. It's not designed to generate cash. Some agent might have tried to tell you there might be a little cash in it. It's not designed for that. What we do is, if you think of the teeter-totter, most policies have low or no cash, maximize death benefit. That's a death benefit protection policy. That is 99.9% of insurance policies sold in the United States. About 0.1% look like this. Max cash, minimum death benefit. Why did your insurance guy tell you about it? Or your financial guy tell you about it? He probably didn't know about it. One. And two, or he's not dealing with the ultra-wealthy. It's that simple. Family offices, if people are familiar with those, 10 million more in liquid assets or more, they use these routinely. I was fortunate 5 or 6 years ago to get introduced to that world through the American Medical Association, and I learned about it then. I was a top 10 producer in the country 12 years prior to that and didn't know about this until I got in that world. Does that make sense? Then I started using it for myself. It's changed our financial future, and it's changed our situation. So we are in the top 1% income earners and all that now too, where I was sometimes and sometimes I wasn't before, right? Bottom line, if you own an insurance policy, does it have a value? To your heirs, right? It's a guaranteed cash contract, isn't it? You get hit with an ice cream truck, you're going to pay somebody, right? Can you borrow against a cash contract? Anybody heard of Peachtree? what is it? What, J.G. Wentworth? Any of those? They buy annuities and settlement contracts, right? Most contracts don't let you borrow against them, but a few do. And this is where I'm going to open your mind a minute. What if, and I'm just going to throw this out there, what if you set up $1 million insurance policy on yourself? And I don't know what the value of, today's value of that is, because everybody's age and health is different, right? But let's just say today's value of that future benefit's $100 grand. And what if the company allowed you to access that value today from your future death benefit? So Manny, you have access to $100 grand. Tax-free, and you don't ever have to pay it back. It gets paid back when you die. So your heirs get a little less. Any ideas what you can do with $100 grand?
A lot of ideas.
Hello? Anybody any ideas in this room? You have created a credit facility for yourself. You've created another asset. With a small amount of money, you've created a much larger asset that'll pay eventually at some point in the future, and frankly, you'll never see. Your heirs will, but you won't. And you can access a portion of that today. And then each year, as you get older, you can access more and more and more of it because you're getting closer, actuarially speaking, right, to it paying. You have an increasing access to tax-free funds, guaranteed, insured, and tax-free. In a nutshell, that's what all this is. I can go into a bunch of details for you, but I want to kind of wrap it up because we only got so much time. If you want to know more information about this, I'm going to tell you the best thing you do. Frank, both Franks, please stand. Father and son team. They live here in Denver. I'm in Phoenix, as you heard. And what I would strongly recommend. Now, I was in LA last week. I'll be in San Diego. We're going to be sending out the email information. If you gave the person in the front, we're going to email out a bunch of information and this contact stuff. We're not going to bug you. We're not going to sell your name. We're just going to send you stuff. If you tell us to stop bugging you, we stop bugging you. Okay? Simple as that. What we ask is just work with us in terms of where you're at. If you're ready to go, let us know. If you want to look into more information, let us know. If you want to contact you in a month or 6 months, let us know. And we'll work with you on that. Because I work with a lot of real estate investors. They're like, hey, this looks great. I want to get started, but I got this deal and I won't have money for 3 or 4 months. Can we chat then? Sure. Okay? It's that simple. This infinitebanking.org website, Nelson Nash, I have nothing to do with it. He's the granddaddy of, he's been doing this over 50 years. There are decades of newsletters on this concept. You can really dig in and learn a lot of how this works. Also, remember what I said about corporate CEOs? They read, right? You want to separate yourself. Start reading if you're not already doing it, okay? This is the best book I've read on this concept. We have a couple here. If somebody wants to buy one here, they're $25, or go online, Amazon, about $25. Excellent book. Some of our folks literally hand this book out to people, and they read it, and literally, usually what happens, they call us back in a few days and say, what do I need to do to get started? Seriously, read the book. Check it out. Upcoming events. In May 19th, if you know anybody out in Santa Barbara area, I'll be out there doing a health and wealth event. I'll be teaching Dr. Scott Saunders, who's a pretty well-known MD who switched to naturopath, will be teaching how longevity stuff, which is really cool. And he asked me to come speak with him because he's been using the banking concept himself for over 15 years, and that's how he built his practice. He loves it, and he wants me to share. We do about a 1 hour. Actually, what we do is I do a 30-minute intro. So I kind of go over some of the stuff I did in the beginning. The next 30 minutes, I share an advanced concept. I'm going to touch on a couple thoughts there real quick for you about how to create 2 income streams off the same dollars. All kinds of cool stuff there. I'll show you how to make 10, 15, 20% on your money guaranteed, insured, tax-free by doing multiple banks called branch banking. We share those kinds of things at these webinars. Bottom line is I do a monthly live webinar. They are recorded if you can't attend, so please register at least so you can at least watch it if you can't attend. But the live webinar is powerful because the last 30 minutes people ask questions, and the questions are awesome many times. You can ask any question you want, I don't care. You're not going to surprise me, okay? So that's how we do those. So check that out. Like I said, we'll send out the information and the registration for the next webinar. Anybody you know of that may be interested, invite them to that, or spouse. You took a look at this. Here's what's going to happen for many of you. You just saw this idea and you thought, wow, this is interesting. And you're going to go home, talk to your spouse or friend or financial person or whoever it is Who's your confidant? Because I told you to stop listening to broke people, but you're going to do it anyway. It's hard to break old habits, right? Remember, if you want to be a 2%er, who should you be listening to? 2%ers, okay? But anyway, old habits are hard to break. And you say, I saw this great thing, and honey, we're going to go buy some insurance. And we already know how that's going to go over, right? Get that person involved. Check out the webinar. Just say, look, I looked at this personal bank concept. It looks very interesting. I think some could benefit. I want you to listen to this webinar. Let me share how it works. And at the end of the time, then honey's going to say, you're right. We need to buy some insurance. Okay? That's what happens. Because you in this room right now know more than 99% of the folks out there about how this works. Even if you're just introduced to it tonight. Okay? All right? So, next steps, register, attend the webinar on the 15th. Check out the information we gave you. We're also going to email out some more information ongoing. If you want to contact me, there's my email. It's Ferenc@securemgt.com. Or reach out to Frank at securemgt.com to set up a meeting, answer questions, whatever. There'll be no pressure. And if anybody, I'll tell you right here, if either of these guys pressure you at all, you let me know. I'm not worried about them. They'll educate you. They'll help you they'll guide you. They'll give you advice, help you make the best decision for you. Okay? It's that simple. Bottom line, earn more income, gain control of your money, have more money to spend in your lifetime. It's been a pleasure.
Thank you. Thank you so much. Appreciate it a lot. I have